I'm Adam Grimes, and welcome to Module 3, Unit 6 of the Art and Science of Trading. Our topic today is market cycles. A lot of people talk about market cycles. We're going to talk about them with a little bit more precision than you usually hear, and I hope to do this pretty quickly. So the cycles we are going to cover. We're going to talk a little bit about the Wyckoff cycle. We're going to talk about behavioral and psychological cycles in prices. We're also going to talk about cycles and prices. This is what most people mean when they talk about cycles, but there's more, as you can see. We're going to talk about volatility, cycles and volatility, and then last, we're going to finish up with a look at what I think is the one cycle you really must know. And this is the cycle in the market moving between balance and imbalance, between equilibrium and disequilibrium, or as you already know it, between trend and trading range. So we're seeing the same sort of thing we've seen. So we'll talk a little bit more about Wyckoff later, but I just want to introduce you here to a framework that is old, but very useful. Wyckoff's theory of the market was to think of the market in terms of two groups of people. And this dates back to just roughly the early 1900s. So basically you have the smart money, and in his day, there were pools that operated. Today, the smart money might be something else. And then there's the public, which is, someone's the smart money, who's the dumb money, right? And so what he postulated, and it turns out whether it's true or not, it's a useful framework, was this cycle where the market would go through accumulation and then through a markup phase and then into distribution and a markdown phase. Now, you may look at this and say, wait, I already know this. The market is in a range, it's in an uptrend, it's in a range, and it's a downtrend. And you're correct. These price structures that Wyckoff looked at and talked about, he actually did not talk about patterns in the way we think about chart patterns. We'll cover that later. But these patterns in prices and price movements, he was more focused on the why. What was behind the cycle, what made it happen. And his idea was that just think of a stock. And so and this applies to any market, but if you have a stock, the smart money starts to buy it without lifting prices. And they would find ways to do this slowly over time, maybe buying weakness. And they have to show their hand in the market a little bit, but basically they don't want people to know. They want to buy something without moving prices. That's the key in accumulation. So then in what I've called uptrend, which markup is probably historically the more correct word, at this point they let the public know, or the public figures it out and the market starts going up. So you have your range and then your range breaks into an uptrend. Now, someone's buying, someone's selling. In the uptrend, the smart money that bought here is selling to the public here. And distribution, this happens when the market goes into a range at the top. The public is still very optimistic. The public has a remarkable ability, and we'll talk about that in a moment, to be out of phase with the market cycle. So that's one of the things you need to take away from this. Perhaps the insiders are actually even going short here. The public is very bullish still. And the market collapses eventually into a panic, and then we can do this over and over and over. So that's the Wyckoff cycle. Now, you'll hear a lot of people talk about accumulation. They'll say a stock is under accumulation. If you want a fun hobby, look for people talking about that and say, wait a minute, how do you know that? And a lot of times they have a pet indicator or something, but many times people are just talking about a stock they think is going to go up, and they'll say it's under accumulation. But if you really dig into it, you will find, and even the people that talk about this a lot from a purely price pattern perspective, there's no reliable way to tell the difference between accumulation and distribution. If there was, we would always be on the right side of the market. And we know that's not possible. Why? Because we know markets are highly competitive. The same thing you've heard over and over from me, right? The cycle is highly simplified. Reality, of course, it's a model, right? Reality is much more complicated. Anything can happen at any time, and there's a lot of confusion and noise. We don't know where accumulation ends, markup begins. There's a lot of different ways to look at this, but even though this may not be a cycle that you find easy application it is a cycle that I think is very useful. What are the lessons here? Well, price movements are driven by the interaction of supply and demand. Evaluating price action, how the market is moving. I don't mean price action in a formal sense, just how the market is moving. This can, in price structures, if you will, market structure, this can give us some insights into this balance of buying and selling. It's extremely useful to think of the market in simplified groups of participants. This is a good psychological framework. Also, the idea, the other thing here is some people, they don't want to be involved in the market, or they will complain about the market because they say it's manipulated. Yes, the market is manipulated. All markets are manipulated. If you can't accept that, you cannot participate in financial markets. The point is that we see the manipulation, we understand the manipulation, and we can work within it. And we can avoid being manipulated more often than not. There's certainly a huge psychological aspect to market structure and to the movements of prices. And last here, this is just another variation of this. This is maybe the why, or one explanation at least for the why behind the trend and trading range. Now, we talk about behavioral cycles. So you've seen there are variations of charts like this, and what you will see, I'll just kind of talk through it. When the market's going sideways, nobody's paying attention. Nobody is interested when a market is chopping sideways. People are not on television talking about it. They're not writing blogs about it. They're not on Twitter about it. It's not sexy. It's not exciting. And this is probably the same when something starts to break out. Nobody notices until they do, and then probably the first reaction is, wait, this is wrong. Why is this going up? Let's short it. Let's fade this move. That you'll see a lot of that. At some point, acceptance sets in. People say, okay, this is really going higher. Then people start to get a little bit panicked and say, oh, I gotta have it. It's going to the moon. It's going to keep going. And of course, when people really start to think that, what happens? It goes sideways. When everybody thinks, and we talked about this before in the context of climax, right? When everybody thinks it's going higher, it's not going higher. And so what happens, of course, when this starts to break down, it's wrong. The market's not wrong. If you think the market is wrong, unless you're a fundamental trader working on valuation, but if you are a price-motivated trader, the market is not wrong. You can be wrong. The market can reverse its move, but if you start to think the market's wrong, you get in trouble. And then maybe it'll come back. I've heard so many people say, I'm not going to sell it. I'm not going to take the loss. I'm just going to hold on to it. Futures traders don't say that, but stock traders say that. That's a very bad way to think. Some point, okay, I guess it's going down, and then at some point there's some kind of panic and acceptance. Maybe everybody's shorting it, people writing articles about it in different places, and then it levels out and we do this again. So why are people so out of sync with the market? It is not that people are stupid. That's one explanation. You look at the stupid traders and you say, oh, and sometimes we'll feel it ourselves a lot of times, right? How can I be so stupid? You're not stupid. And this happens really because I believe that price movements are the sum result of human experience and emotion. We've talked about this a little bit before. Human behavior is more predictable in crowds. If you have one person, you're not so sure what that person is going to do. If you start to look at a crowd of people, we can start to make some pretty good predictions within the realm of statistics what we think the crowd is going to do. This is probably the most important thing. The market has evolved to encourage individuals to do the wrong thing. And that is a consequence. Goes back to our first rule. Financial markets are highly competitive. And when people are competing, they're competing by buying and selling and by issuing different kinds of false signals and tricks. There's all this stuff that goes on in markets. But the bottom line is that these price movements have evolved to encourage us to do the wrong thing. And people swing, if you think about the classic pendulum, which swings between different extremes, right? Back and forth. This happens in politics, happens in art, happens in fashion, certainly happens in financial markets. In financial markets, we alternate between fear and greed, optimism, pessimism, hope and fear, loss, sorrow, excitement. So there's not a lot in the middle. when the action in the middle is the boring action we don't really pay attention to, but markets tend to be driven by these extremes. Markets are also driven by trapped market participants. And this is important, that there was, and I've mentioned this before, there was a mania a few years ago. Everybody was writing all these technical books about profiting from trapped traders. And, okay, maybe there's a point for that sometimes, but it's not the answer to all technical trading. One of the things I do want you to realize is we think about people being trapped into a move. So we think about people buying something and then it declining and they're stuck and they have to get out. Realize that particularly in large-scale trends, people are trapped out. And this is one of the things that I believe drives bull markets and stocks when you have these large groups of uninvested money that are sitting on the sidelines thinking somehow I have to get into this. We've talked about crowd psychology at extremes. One of the other lessons here is that people have made these same mistakes. There are similar patterns in financial markets in the full history of financial data. And literally we have some very spotty, questionable data going back to antiquity, but we have better data in the Middle Ages, 13, 14, 1500s, and we start to have stock prices a little bit later. And if we go through those prices, we see people doing the same things over and over. And while markets, this is one of the great debates, right? What changes in markets, what stays the same. But one of the things that's very interesting to me is that even as many things do change in markets, we see a lot that stays the same. There's also this idea about price movements, and you'll hear people talk about risk on, risk off. People talk about risk aversion. And what this means, because you're definitely going to hear people talk about this, is that when we're in a risk on mode, investors are seeking risky assets. Now, what would be risky assets? Smaller stocks. Stocks in general might be seen as risky. When people move into this risk-off mode, they seek what are perceived to be safe investments. U.S. Treasuries, gold, more conservative stocks, defensive stocks. This does work very well to explain. You can look back over the history of markets. It's a little bit more difficult to figure out how to use this going forward, but you definitely can see, and you will see. Right now we're in a very complacent period in global financial markets, but it will happen again. And perhaps by the time you've watched this, it will have happened, or it may be happening, that you will see when global markets come under stress, everything kind of moves together. Correlations roll toward one as everything moves together in these big risk on and risk off kind of panic moves. So that's another psychological cycle that is underneath prices. So price cycles, this is what people think, right? Seasonality would be a variation of this. You can use all kinds of complicated signal processing tools to find cycles and prices. And you can even do it in a relatively simple way. You can count periods between swing highs and swing lows. Oh, look, there's that again, right? On price charts. One thing you just need to know is that these cycles, they're great when you see them historically, but they shift all the time. They abort into trends. They change periods. If you're counting cycles, you will see things where you will find some cycle and then the cycle lengthens or resets or something like that. All kinds of variations. Don't assume that because you can see it on a price chart that you can necessarily trade it, or you even could have traded it historically. One of the really important things to do, hey, guess what? Markets are extremely competitive and there's no free lunch. Have you heard that before? Well, here's a place where it really plays out. If there were predictable, easy cycles in price, let's go back a screen. So you had a market that reliably oscillated between highs and lows on a regular period. This does not exist for long in financial markets because what would happen? Well, people would realize that they could profit from this and they would start buying sooner. And then they would start selling sooner. And if you think through, I'm going to leave you to do the thought experiment, but buying and selling around these cycles eventually will erode the cycle. And this could be true in seasonality. It could be, there's any number of places that this could be true. But that happens because, and sort of, I've called it the dampening effect of natural buying and selling, and the competitive nature of markets will erode simple cycles. So what I'm suggesting here, there's also, by the way, a lot of mysticism around these cycles. There's two kinds of cycle work that you should consider. There definitely are places where people are applying complex math and tools borrowed from, say, digital signal processing to financial markets. That information is potentially useful. There also is a school of thought where they use, I'll say, woo-woo. They'll use cycles from the pyramids or cycles from astrology. And some of this, frankly, is just kind of crazy. Like, I can't entertain it for very long. Then there are other cycles, maybe, where you look at sunspots and things like that. There's some stuff that is a little bit out on the fringe that we could start to analyze, but it's a lot of ways that people look at cycles and prices. It's worth spending some time thinking about. Cycles and volatility. Well, we have not really talked much about volatility. Volatility as one of the ways to see it would be to look at the range of bars. And this would be a market where the volatility is increasing. The problem with volatility is that we don't see it directly. We have to measure it. And there are a lot of ways to measure it. There's one way to measure it, measuring the range, where I could guarantee you the volatility was increasing over this time. But there are other ways, for instance, if we were measuring statistically looking at the closes, where you might find the volatility in this example that I've drawn is actually decreasing. So we'll talk more about this later, but volatility is a little bit problematic because anytime we look at volatility, we're also looking at how we measure it. Deep, complex topic. The point here that I want you to realize is that, and you can read that slide. I didn't read everything there. There are more predictable cycles in volatility than in time. This is, now I said more predictable. More predictable cycles in volatility than in, this really probably should say price. Volatility has both trending behavior, mean reverting behavior. Mean reversion is definitely meaningful in volatility. Volatility clusters, you've seen that before. Volatility also has, nothing is easy, significant departures from the average. One of the interesting things about volatility is, so we've talked about this price cycle and how people could buy and sell in front of it and eventually make the cycle go away. This does not exist with volatility. Because volatility is derived from price, it's very difficult. You could do it. Given enough money and a clean enough market, you potentially could dampen the swings and somehow manipulate volatility, but practically not for very long. So perhaps because it's more difficult to manipulate directly, cycles in volatility tend to be more persistent than cycles in price. We talked a little bit about volatility clustering, and this just means that volatile moments in markets tend to be followed by other volatile moments. So once a market goes into a volatile phase, we're more likely to see other big surprises, basically. And there are ways that this is modeled. Some of the academic models, the Garch models, eGarch models, literally thousands of academic variations of these, assume that you'll have a price shock that will hit the market, and then that volatility will decay very similarly to, they're not modeling a physical process, but if you think about throwing a rock into water and you have a big splash and then the splash and the waves decay. Some other things, so that is volatility clustering. Another way to look at volatility is to consider volatility contraction. And volatility contraction is where we have volatility getting smaller, and we've talked about this in context of leading to maybe momentum winning in the near term. Volatility expansion is the opposite of that, where a market becomes more volatile. Just a quick look here at a few things. I've highlighted here with colors the volatile periods. I don't know, maybe I used 2.5. But notice that all of the colored bars, so this guy's maybe a little bit by himself. Here certainly we see clustering. It's a little bit unusual to see them by themselves. We tend to see them come together, and then you will have these long periods. I'll get my marks off the chart. We'll have these long periods where there really are not a lot of large volatile events, and then again they start to come in clusters. So that's volatility clustering, one of the basic quantitative behaviors of markets. And then volatility here, this is a real volatility cycle, and you can kind of see there's a little bit of up and down. Now, How easy would it have been to trade that? Maybe not particularly easy, but there is some predictable natural fluctuation in volatility, and there are ways we can look at that. Here's a quick look at volatility compression. I've shown you before the triangle. Be aware that if you just have big bars and then small bars, especially inside bars, multiple inside bars, this is a form of volatility contraction. You also can have ranges following big moves, and this is same thing again, right? Trend into trading range. I hope you're seeing all of these things over and over in the same context and starting to draw connections, because I think the cycle that really matters most at this point in your development is something we've already discussed, this alternation between trend and trading range. I'm not going to read this. You can read it, but this is all stuff that you understand and you have seen many, many times in this module. You're going to see a lot more in the homework. I'm going to flip through some charts here. Here, I've defined some very short-term trends, and you'll see the short-term trends are interspersed with periods of trading range. And as you know, you might define these things a little bit differently, but this is the driving cycle that you need to be aware of, you need to watch for, you need to understand. Why? Because we structure our trading around this. And I suggest that this is for price-motivated trading. So for technical trading, again, if you're a fundamental macro person, you have a different perspective. But I believe there are only 4 technical trades. And what these let us do is trade this cycle. So the 4 trades are trend continuation, trend termination. So it's obvious what those are. Trend continuation, we're looking for a trend that's working, and we seek to somehow get into the trend. Trend termination, we think the trend is coming to an end, and we position with that. And then there is also support and resistance breaking, and support and resistance holding. These are the 4 trades. And these fit into the cycle like this. So we would see trend continuation leading to trend termination. Think about this. Here's your trending market. Trend continuation. Eventually the trend ends into a range. When the market is in a range, we're trading support and resistance holding. Eventually support and resistance will fail. We start to trade support and resistance breaking, which then takes us back into trend continuation. A very simplified, idealized model, but if you think about your trades, it's falling into these categories. There's 2 big categories of with trend and counter trend, and I've colored these here, that your with trend trade is continuation, counter trend trade is trend termination, and then support and resistance holding and failing are not technically these 2 big categories of with trend or counter trend, but because they can cross, they can be either one. How does this fit into, let's go back to our Wyckoff cycle. Think about this. Support and resistance breaking. You can also relate this to the psychological cycle. And if you can understand what market phase we're in, you can avoid being the public that is out of phase here. So you're not disbelieving the move. You're not expecting the move to stop. You understand that there is a trend, and you're seeking to position with the trend. You're watching for signs the trend may be coming to an end. Once that happens, we start expecting support and resistance to hold. We're on guard for it to break. Maybe we get some clues that it will break, and then we start to trade continuation again. This puts you on the right side of the market. It's a big picture framework. I don't think you can rush out and trade this, but I think if you keep this as the foundation for what you're doing, you're going to find that things start to become a lot simpler and everything starts to make sense. Quick review, Wyckoff cycle. This is accumulation distribution. Plays very closely into the behavioral and psychological cycle, which is just that the public tends to do the wrong thing at the wrong time. And certainly if you read media stories, if you read a lot of bloggers, you're going to find people who will illustrate this vividly to you. We also talked about cycles both in price and volatility. We'll come back to some of those later. And then the cycle that you really need to know, the cycle between trend and trading range. And if there's one thing to take away from this presentation, it is the 4 trade types: trend continuation, trend termination, and then support resistance holding and breaking. So that brings this unit and this module to a conclusion. There is quite an extensive homework, basically. There are many things to look at, and I would encourage you, take your time with those. Really dig into those. Have fun. I think even if you've been trading for a long time, I'm going to encourage you to see the market in a little bit of different ways. And in the next module, we will start to look at actual trading patterns, and we'll take all of this theoretical background and we'll figure out where to buy and sell and what we can do with it. Thank you very much.